Quincy, great to see you again. And why stay defensive if you don't think we're going to have a recession?
Well, we're in a what should I say, a soft patch. The soft patch can lead to a recession if things don't ease up in terms of inflation, if things don't ease up in terms of the supply chain. So it's just a cautionary. But with that said, we're very much looking at the growth sectors, the ones that have been beaten down. And it isn't a question of if, but it's a question of when that we will start inching towards that.
So explain more about where you think investors should be positioned right now.
Well, right now, it's still very much a trader's market. I mean, we see it every day. And I think that as long as they are defensive, the ones that, granted, they can lose. We saw how Staples got hit yesterday. But nonetheless, the Staples should be able to hold up a bit more during this volatile period until it becomes clearer how the economy is going to unfold and whether or not this growth scare is going to materialize into something stronger.
Where do you think the best opportunity in the market is?
Well, I like energy. I think that you're going into the driving season. There is a shortage. There's no doubt about it. As Beijing comes back, as Shanghai comes back, I know that they're buying Russian oil. But the fact is there's going to be pressure on oil prices. I think oil prices are going to continue to rise. So
energy remains a favorite despite the fact that it's already performed so well. Would you throw anything materials or commodities related into that as well?
Well, I would actually look at another area, which is, the infrastructure area, which, of course, includes just about all of those. The country, we're not going into I don't think we're going into a deep recession. I think that we're in this slowdown. But the idea of having to rebuild the country remains. That's been, a premise for both the Republicans and the Democrats. And I think that is going to continue. It may slow down a bit, but I think it's going to pick up as it becomes clearer, what the Fed is prepared to do and how hawkish they're prepared to go. I think that infrastructure and all the various components for it are going to be a good area to be in, not safe, but a healthier area to be in.
Quincy, it sounds a bit like you're predicting stagflation, a slowdown amid higher inflation. That's not good for corporations.
Well, no, I mean, look, there's easy stagflation. You could argue that pockets of the economy are already in a stagflationary position. But if you were to get heavy stagflation, the kind that we had years ago, no, it isn't good. And, it's difficult for companies. There's margin compression. It becomes a much more difficult environment for the economy. We don't think that we're going to be heading in that direction. But needless to say, right now, when you see days like yesterday, you can argue that it had the feel of forced selling. And that actually placates you, because if it's the idea that a hedge fund has to sell margin calls, at least that's the rationale, as opposed to, everyday investors just saying, I'm getting out at any cost. So we're going to keep our eye on that. But also, this rhetoric from the Federal Reserve that they don't care about how difficult the stock market is. I don't believe that. One thing the Fed does not want, they want financial conditions to tighten, but how about not tighten too much? And, if we lose liquidity in the market, that tells you that the Fed has broken something. So they are following this. It is important. But you know what? Right now, the Fed should be actually applauding the rhetoric, because we're seeing demand is starting to pull back, and that should lead to lower prices.
Shepard Smith here. Thanks for watching CNBC on YouTube.